Good evening, ladies and gentlemen, and welcome back to A Day in the Neighborhood. Tonight we have special guests. I'm delighted to have Jason Buckingham, an attorney, and Ben Minor to give us and to illuminate for us what this foreclosure crisis means and how the average person can perhaps avoid foreclosures. Welcome, gentlemen.
Thank you.
So Jason, what do you do?
I actually got into real estate back in 1993 as a foreclosure auctioneer. So I was the guy that used to stand out at City Hall and actually do the auctions when someone would lose their home. And what I learned from that, you know, really hit home for me, because a lot of people lost their homes in the last economic downturn that we had in the mid-90s. A lot of people lost their homes who didn't need to. And now we're seeing it magnified in the current mess that we've got. So what I've done, now that I'm a lawyer, I reach out, I represent clients to try and negotiate with their lenders to make their loan terms more affordable.
Ben, you had been a community leader for a long time. What prompted you to work on foreclosure issues?
The foreclosure problem creeped into many communities unsuspectingly.
Right.
And as a member of the National Federation of Filipino American Associations, we realized afterwards, with the crisis hitting at its peak starting in October of 2008, many families and community leaders were looking for answers and solutions.
Right. Tell me, if a person loses their job and suddenly they are confronted with this dilemma, what do you think they should do?
Yeah, it's a really difficult issue, and it's becoming more and more common. As I just saw a figure for 2008, we lost close to 2 million jobs in this country,
right.
And lots of people are being affected. The unfortunate thing is, because our historical savings rates have been so low,
right.
people aren't prepared. Too many people live paycheck to paycheck.
Right.
And of course, you hit the nail on the head. We have a lot of exotic loan products that were made available during the last real estate cycle that had more traditional loans been more widely available instead. Maybe we wouldn't have the crisis to the extent that we do now, but for people who lose their jobs, short of having savings, they need to reach out to their lenders as soon as possible and try and talk to the lender, see if they can get some time. Lenders are interested in talking to people. The real frustrating part right now is they're not that interested in coming up with long-term solutions. Most of the solutions that a borrower can get when they're in distress, very short-term, 30 to 90 days at most. That's usually the first round of relief that a homeowner could expect. But for someone in a situation where they suddenly lose a job, that might be long enough.
Right.
We have a concern in NAFA in the fact that some of the lenders are not responding appropriately to their borrowers. When the borrowers are trying to communicate to the lenders to make the adjustments or loan modification, as one congresswoman tried to do in LA, it took her almost the whole day to finally reach a live person to address the concerns of one of her constituents who is going into foreclosure. And so we at NAFA, Mabuhay Alliance, and Green Lining are asking our congressional representatives as well as our state legislatures to strengthen any kind of legislation to make the lenders, the banks, more responsible to the consumers and the borrowers. Otherwise, time is of the essence.
Okay, the federal government had given about $350 billion to banks, to the financial companies, as part of this bailout package. Of course, the newspapers have been exposing that instead of using that to help borrowers or homeowners, they've used the money to give themselves bonuses. They've continued their exorbitant lifestyles and so forth. Now there's another $350 billion that have yet to be released. Has the President Obama done something to, in fact, close that loophole?
Well, it's interesting because while we know the incoming administration has homeowners' well-being at the center of the economic plans, the real issue is that that bill is something that's already been enacted by the Congress, and it's the Congress and the Treasury who help determine a lot of how the next round of money gets spent. Some of it will be determined by this new Congress. The President, through the Treasury Secretary, will be able to attach some strings, but it remains to be seen. We know that there are many proposals floating around throughout Washington, D.C. as far as the kinds of restrictions and the kinds of accountability and transparency that they want to propose for the next round of the TARP money from the bank bailout. But none of that's been finalized yet. And I think that the longer that banks have to wait to get that money, the better it might be for homeowners, because really the biggest problem that we've had with lenders being responsive to homeowners, most lenders thought that the Treasury Department was going to buy their pools of really bad non-performing loans,
loans
at full value.
Right.
That would have been, I'll tell you, a loan when it goes bad, if you're a hedge fund and you're willing to buy a non-performing loan, you can buy it for about 20 cents on the dollar.
Jeez.
Well, these lenders thought, well, we'll get Uncle Sam and the taxpayers to buy these loans for 100 cents on the dollar.
Right.
Even the first round TARP money that went out and bought securities and secured positions within these lenders, a report just came out last week, Treasury overpaid on that first round.
Yeah, exactly.
$75 billion. They overpaid by 20%. So whatever they come up with for the next round of TARP money releases, with that kind of track record, one could only hope that they would do better, because they have nowhere to go but up. That first round, they really, under the Bush administration, they didn't do the best job.
Right. Now, if let's say, a homeowner is encountering some foreclosure problems or about to, but they know that their bank has gotten a bailout, do they have any recourse? Is there somebody they can call and say, hey, these guys have gotten bailout, but they're not helping me and people like me? What can they do?
Well, NAFA, Mabuhay Alliance, and Green Lining have been asking Congress and the Housing Urban Development Agency to certify more loan modification counselors, because you have to be certified to help process a borrower's loan, to help them advocate change on that loan with their lender. Unfortunately, government's sitting on their hands and not making more effort to provide certification and enough funds to certify these qualified individuals.
The unfortunate thing is there's a lot of truth in that, but what happens with a lender whenever they have a non-performing loan, there is a downside even for the lender. It's twofold. In California, the average foreclosure costs the lender in real terms about $70,000. That's their hard costs: foreclosure fees, costs to hold the property, costs to resell the property.
Exactly.
When you look at their actual total loss, I just read a study that came out, they're figuring it's about $145,000 in lost revenue, in reserve requirements and so forth. So when you look at the real losses that lenders face and you understand how banks actually operate, any bad loan that a bank has to take back, they have to take money off of their revenue and set it aside in a reserve fund, and they can't put that money out back to work. Well, when you have a big pile of foreclosed properties, that's evidence of many, many bad loans. The lending industry only works if they can put out new loans. And even if you ignore what's happening in the economy in general, any lender can only afford to take on so many REOs and so many foreclosures. So they reach a tipping point where it makes sense for them to stop the bleeding and start fixing these loans so they perform again, because once they're performing assets again, not only do they get a stream of revenue from it in the form of their monthly payments, now they don't have the reserve requirement to meet anymore. Well, there are some lenders that I've been working with where what we do is we look at the real value of the property right now, because so many properties, especially here in California, are worth less than the balance of the loans that are supposed to be secured by that property. So we take a realistic approach. We reach out to the lender and say, look, here's the real value of the property.
Right.
What we want to do is we want to take the loan balance and chop it into two parts.
Right.
The first part, the borrower will actually make the payments on. That will represent your actual secured value in the property right now.
Right.
The second part, we're not going to ask you to forgive it even.
Right.
What we'll do is we'll put that to the end of the loan.
Right.
And it's there. The investor gets a full recovery of their principal balance upon maturity, and now we've got a performing asset that's affordable enough for the homeowner
Right.
that the risk that they actually redefault is very, very low.
Exactly.
Now, that's one option some lenders are doing right now, but there's a lot of resistance. Many lenders are not. The good news is that the folks in Washington understand this. Ben just referred to Representative Maxine Waters from Southern California.
Great. I love her.
Maxine Waters is the one who sat for hours on hold trying to help her constituent with the home lender, and it's reached the level of outrage within Washington, D.C. There is a very exciting proposal to amend the bankruptcy code to help, if the lender won't do these things voluntarily, then the idea is to give the bankruptcy court the power to make them do it.
And Myrna,
excellent.
We need to put a moratorium on the foreclosure, meaning stop any foreclosures.
Is that, can that be done? What would it take to do that?
Well, there's some legislation going on right now, at least in the state of California, with Assemblyman Ted Lieu. And Ted Lieu is trying to pass this bill to have a moratorium on the foreclosures of any home for at least 6 months, so that counselors can come in, lawyers can come in, and assist the consumer.
Exactly.
Because there's so much. I mean, 400,000 homes is just not enough people to work and service them. Right. And yet each day or each month there's a bank that's closing themselves.
Exactly.
And last year there was 171 banks that foreclosed.
That failed?
That failed. 171 banks nationwide, and already today 3 have already closed, and this is only in February, and more to come.
Oh, geez. Well, that seems to be a brilliant idea, to the moratorium. Now, how will that work structurally?
Well, it's like when Franklin Roosevelt declared the national bank holiday in 1933 during the depths of the Great Depression. The issue really, though, for a state to try and do it, even a state as large as California, you know, I mean, by economic standards, we're the biggest state. The issue is that banks, especially nationally, federally chartered banks, can say, well, we're exempt because we're a federally chartered organization. And so it makes it very difficult to try and do it state by state. For something like that to have teeth, it will probably have to come from Washington.
Exactly. If an elderly has of course only have a fixed income and they've had a home for a long time, and suddenly they are in imminent danger of losing their homes, are there special exemptions or help to elderly people? What do they do?
Well, under current bankruptcy law, what happens is when you have a secured loan, like a home loan, if the asset is worth less than the loan balance, for most loans, the bankruptcy judge can modify the terms of the loan. One of the things that the judge can do is called a cram down. What a cram down is simply saying, look, your loan balance is $500, the asset's worth $300, now your loan balance is $300 because that's the secured value of the loan. And then they can adjust the terms accordingly. There is one category of secured loan that a bankruptcy judge cannot touch, and that is a first position loan on residential real estate. And it's so frustrating because that, for most people, is the #1 asset that they have and the #1 largest liability, so that if, just to take the example of the elderly lady on a fixed income, if she gets a phone call, which is actually, this has been very common back during the boom, say she gets a phone call from her bank, hey, tap into the equity in your house, we'll give you a pick-a-pay loan, you only have to pay a few $100s a month.
Exactly.
And you can,
what do you think she has the first and the second loan?
So what happens is, in the current rules, the judge can look at the value of the house, and as to a second loan, if the second loan has no security based on the current value of the house, they treat it like a credit card. It becomes an unsecured debt. The lien gets invalidated. They set it aside.
Okay.
But the judge cannot touch the first loan. And the issue right now for someone who files a Chapter 13 bankruptcy, if they don't have enough income, because some first position loans, you know, some of these option arm loans and loans that were indexed to an odd rate like the 3-month London interbank offer rate, the rates went so high. I've got clients, their loan payment is $7,000 a month or more.
God.
So even if you're making a lot of money, you have any interruption to that flow of your cash flow, it becomes very easy to be in a position where you can't afford that.
Right.
Under the current bankruptcy rules, the judge would have no power to alter that first loan. And if the borrower cannot keep current with those payments based on their current income, they get thrown out of bankruptcy court and the foreclosure happens. The proposed changes under Senate Bill 61 and House Resolution 200 would take the handcuffs off the bankruptcy judge and let the judge treat a first position home loan just like any other loan. The neat thing is that throughout our history there have been times when bankruptcy judges could do just that. Most recently, from the period of 1981 through 1993, there were parts of the country where bankruptcy judges had that power. Right. And then there are other parts of the country where they didn't. There have been studies that looked at what mortgage rates were in the areas where this could be done and the areas where it couldn't be done. There was no difference in the mortgage rates. The biggest argument against the proposed change, because it would be nationwide, the Mortgage Bankers Association understandably has come out against it, and they're claiming that this would cost a lot of money, loans would become unaffordable, and lenders wouldn't want to make the loans. But we already had a period in our history where this was actually something that happened, and there were no differences in the pricing or availability of mortgages. So there are a lot of people who've gotten on board now. Even a gentleman named Louis Ranieri, who is widely regarded as the father of the securitized mortgage. He helped invent this whole secondary market in residential loans. And he also is the person who he wrote the bankruptcy code exemption that got rid of the last time that a judge could rewrite a first position loan. Even he's on board with the current proposal. He's looked at the economic realities that we have, and even he understands that this will be a net positive for the economy and also for working people to be able to hang on to their homes.
So, is there a provision in this bankruptcy code that helps people to stay in their homes?
Yes, absolutely.
To keep their homes.
What the proposal would do is it would let a judge look at the real value of a property. So if you're an average Californian, you're living in a house where your loan balance might be more than the actual value of your house if you went to sell it on the market. If you have a job loss or a medical emergency or a divorce, any other number of reasons that puts you behind financially and makes it so you cannot stay current on your loan. Under the new proposal, that homeowner would have the option to file for bankruptcy protection, and then within the court system, the judge could look at the value of the house and the loan balances and then adjust the loan balances, adjust the interest rates to conform to current rates. There are a lot of people, I've got a client who has a second loan with a 20% interest rate.
Oh my God.
You know, and I've seen a lot of of course, and I've seen a lot of first position loans where the rates are over 7.5% up to 11%. So, you know, the prevailing fixed rate on a loan today is between 4.5% and 5%. The judge would have the power to adjust that interest rate and to adjust the loan balance down to the actual value of the property. That would make it affordable, even if you have a reduced income, for a lot of people to stay in. But the more important thing is the threat of being able to go and drag your lender into the bankruptcy court. That's the real power of this proposal. It gives the homeowner leverage with their bank, because what it lets someone like me do is contact the lender and say to the lender, we can do this. We can, if you're willing to come to the table and change the terms of my client's loan and make it affordable for them based on what they can afford right now, then we're done. But if you don't come to the table, then next week I can file for bankruptcy on my client's behalf, and then we can just ask the judge to make an even better deal than the deal we're offering right now. That kind of leverage is really the main reason that the Congress has these particular changes in mind. It's to convince the lender that
Right.
they don't want to end up in front of a bankruptcy judge.
Senatorial.
Who is the lead? Is that Maxine Waters?
No, the
Who's the
lead
sponsor?
sponsor is Senator Richard Durbin from Illinois, the senator who served with President Obama when President Obama was in the Senate.
In the HR.
On the House side, it's Representative Conyers.
Okay, okay. So they're the sponsors of the
Mm-hmm.
bill.
But we need all of them to support it and get it passed as soon as possible. Unfortunately, as Jason can tell you more, it should have been on the stimulus bill, but that
That's
was
right.
one of the things that was taken out.
By the Republicans.
Yes.
What happened was the administration wanted to get bipartisan support in the
Right.
House for the stimulus package. Part of the deal was they said, okay, well, originally they were going to include the bankruptcy bill with the other economic bills.
Right.
They set that bill aside, and then they didn't get a single House Republican vote. So now, just the status of the bills in the House, my understanding is the bill has already come out of committee. It's been amended in committee and it's come
Right.
out of committee, so it could actually be up for a floor vote, you know, as soon as a couple weeks from now. On the Senate side, it's still in committee, but the good news is that the way the Senate operates, as long as Senator Durbin can assure himself that they can withstand a filibuster challenge,
Right.
then that could come out. And it could be rather quickly that it gets passed, but as it stands right now, it still is just a bill. And so the good news is we have every expectation that it will pass. It's really a matter, as Ben said, of how soon, because it can't come a day too soon. We should have had this in
Exactly.
place months ago.
Now, with the president's stimulus package, is there a portion in there that helps people who are confronting foreclosures?
We hope that it could be written in. But
Is it
has-
not in the stimulus package now or no?
Only to the extent that they want to create jobs right away.
That's right.
Really, this first wave of the stimulus package, the idea is to get as much of that
Job
money
creation.
into the economy
Right,
within the
right,
next
right.
18 months. Because of that, the measures, because there are measures on the table and that are in the works in Washington to try and assist homeowners and really lean on banks. I
Right.
happen to believe, it's my opinion, that the bankruptcy bill will actually be the most important component of that, because the minute that that hits, like I mentioned, it's leverage for the homeowner, and it's a big incentive for the lender to make more reasonable long-term solution kind of deals. One of the issues, the lending industry has their Hope Now Alliance,
Yeah.
and you hear them claiming that they've helped 500,000 people stay in their homes. Well, there's been a study done. A law professor at Valparaiso School of Law actually looked at what the Hope Now Alliance did. More than half of the so-called deals that the Hope Now was able to give to
Right,
the
right.
homeowners increased their payments. It
Right.
actually made it less affordable to stay in their homes.
Yeah.
That's a recipe for failure. In
Exactly.
a market where we've
Exactly.
got declining values, very difficult to sell your house, and people are losing jobs, that is not sustainable. And people are tired of lip service. They want real
Right, right,
solutions.
right.
So I think that among the other proposals that are in the works right now, I still think that the change of the bankruptcy code will give us the most results right away.
Exactly. I mean, that's excellent. Now, if some people are just dead broke, how can they afford a bankruptcy lawyer?
Well, the nice thing about bankruptcy, depending on the chapter that you're filing,
Right.
if you're that broke and you need to liquidate and file a Chapter 7, then the filing fees, well, the court fees are one thing, but the attorney's fees for a Chapter 7, they vary from area to area.
Right.
In Northern California, the Bay Area, generally a Chapter 13 will be a Chapter 7 filing, the attorney's fee portion will be somewhere in the neighborhood of $1,500 to $2,500
Right,
for the
right.
attorney's fees. If you're filing a Chapter 13, if you have the income to actually come up with a payment plan,
Right.
then most Chapter 13s, you're looking at anywhere from $3,000 to $4,500, depending on if you own your own business,
Right.
and some of the complexities related to your bankruptcy estate.
I'm sorry, could you
Yes.
clarify to the audience what's the difference between Chapter 7 and Chapter 13?
Sure. And you know, without getting into too many details, because
Right,
it is a
exactly.
rather dry subject.
Exactly.
That's why, you know, that's why the lawyers charge what they do, to, you know, mainly to stay awake while they're reading everything. Chapter 7, bankruptcy, is a liquidation where the debtor does not have the means to set up a payment plan. And so what happens is, as to the unsecured debts, they end up getting discharged at the end of
Right.
a Chapter 7. Chapter 13 is designed more for people who actually have regular incomes, but their obligations are more than they can handle based on the income that they have.
Like Donald Trump.
Well, it's interesting, you know, Trump's organization has actually been through bankruptcy a few times, but he gets to the benefit of the corporate bankruptcy.
Oh.
For individuals, a Chapter 13, you'd actually set up a payment plan. It allows you to keep your secured assets, like a home or a car, if you've got loans against those
So
assets.
for homeowners, Chapter 13 would
13
be...
is what they usually look at, but not always. I have clients who are homeowners who have filed Chapter 7s just to get rid of their unsecured debt,
Right.
to make it easier for them to afford their house payment. So it really depends on the individual situation.
Right, right. But the homeowner, if they liquidate their homes and there's no equity, can the bank still go after them or no?
Generally, that's one of the nice things about the bankruptcy filing. People worry about a bank coming back and suing
Right.
them. We have state laws in California that limit the availability of a lender
Okay.
lawsuit.
All right.
But in addition to that,
Okay.
a bankruptcy filing will generally protect the debtor
Okay.
against personal liability.
All right,
to
we're
the
running out
lender.
of time. God, guys, this is excellent. This is excellent. So anyway, thank you so much. We're looking forward to your workshop on the 22nd. This is Myrna Lim, and good night.